What would you do if $1 billion dropped into your bank account tomorrow? Would you stuff it under your bed? Would you buy a private jet? Or would you buy a new yacht? Those are nice and all, but here's a step-by-step guide as to what you should actually do. Step 1, don't tell anybody unless it's a lawyer. You really want to make sure that people aren't your friends and leeching off of you just because you have now $1 billion. But realistically, you're not going to get all of that because you have to pay a bunch of taxes. But they know you have money now, which is very, very scary. Make sure that you sign the ticket and save it in a very secure place, like a safe at home, under your favorite kitchen bowl that no one is ever going to find, but make sure that your name is on it so they can't redeem it. And depending on which state that you come from, you're gonna want to look into legal trusts. Next, you're going to set up anonymity. That's anything with trust, legal structures, depending on the state that you're in, and just look into what you can do in terms of anonymity. Step 2 is getting the right team to propel your wealth forward. That's going to be looking into a lawyer, getting a CPA or tax specialist, or getting a financial advisor to make sure that you can spend all this money fiscally and responsibly. The lawyer is really going to be able to set you up for that anonymity that you really need and set up that trust for you just to keep everything in a nice place. Because at the end of the day, you want to make sure that you own all of these dollars. And then the CPA or tax specialist is going to be the person that is going to keep your $1 billion winnings as low as they can in terms of the tax bill. They're going to make sure that you're writing off as many things as you can to make sure that this income that hits you on your statements for the year isn't going to be taken all away all at once. And your financial advisor or planner is really going to diversify, plan, and protect your wealth. At $1 billion, you really want to make sure that somebody is going to be watching what comes in, what comes out, and how you're going to invest that money to take money out of that $1 billion and not spend it all in one single year like most lottery winners. Step number 3, you're going to make sure that you understand the payout. When you win these kind of lotteries, there's going to be something called a lump sum payment and an annuity payment. Now, a lump sum payment is going to be an immediate payment that's going to be a smaller amount of the jackpot, but you're going to get access to that immediately. And this option really is going to be anywhere between 40 to 50% less than the advertised jackpot, but you're going to get that money as soon as possible. But make sure you're going to pay those taxes. So put that money aside for taxes. Now, the reason that people take this lump sum payment is because 1, you get immediate control. 2, you have the potential for greater returns. If you take this immediate money and you put it into, let's say, a vehicle like the stock market, that might actually get you a better return than you would have by just taking the distributed payments of the annuity. And you also get estate planning flexibility. Like a lump sum could be easier to pass on through your heirs, and that just might be through a structured plan that you can map up with your lawyer. Now, the con for this is going to be a high tax bracket. When you make this much money, that's going to be heavily, heavily taxed on a federal and state level because Uncle Sam's coming for it. And you risk overspending. It's another con that you get when you get access to so much capital, so much money that you're able to spend. Most people buy yachts, jets, private jets. They buy nice clothes and designer things. And it's all those things that run your pocket dry at the end of the day. So maybe getting payments very slowly to you is going to be the better way to retain your wealth. It's different for everybody. And lastly, it's a reduced overall amount that you're going to get. You're not able to capitalize on the full amount, so which is the last con. As for annuities, there's going to be a larger but distributed payment over the course of decades. So an annuity option might provide an immediate payment that's going to be followed by 29 annual payments, which is 29 payments per year, and each payment is going to increase by maybe 5%. So some of the pros of a annuity are going to be financial stability. You're going to have that money that comes in every single year. You don't have to worry about it. You're going to get for sure money that comes in. You're going to have a managed tax burden, and that's going to be the taxes that you pay every single year. This is going to be able to help you avoid being in that highest tax bracket every single year. And if you're not very risk on, this is going to have built-in growth of that 5% a year. You're hoping that beats inflation, because we know inflation is almost 3 to 4% every single year on average, that you're going to outpace inflation just a little bit so your dollar keeps up. You also get inheritance protection. This kind of money is able to be passed on to your relatives after you're gone. Some of the cons are you have less flexibility, you're kind of vulnerable to taxes, and you can outlive your payments. So your flexibility, you're not able to buy as many things as you'd want to because you just don't have access to that much money anymore. And taxes, as they increase throughout the years, your tax liability overall might just increase because we know damn sure the government is not going to lower taxes. If anything, they're going to raise taxes in the future. And you can outlive your payments just because if you're only paid for the next, let's say, 30 years, then what happens in the next 40, 50, or if not 60 years? You don't have that income of money just coming in through the form of an annuity. But who knows? Maybe you don't need it with $1 billion because that's so much. And what would you do? Unless you buy crazy things. Now, step 4 is going to be eliminating all of your risk. You're really going to make sure that you pay off all of your debts, anything that's high interest, credit card debts that's ranging from 20 to 30 to 40%. And then after that, pay off the lower debts, the 7% car loan, the 10% car loan, and then go all the way down until you have zero debt at all, because a debt-free life is a very happy life at the end of the day. Then you're going to build a fortress around your wealth. You're going to have insurance, you're going to have asset protection, making sure that nobody can go after your assets if you were to get sued one day. And you're going to want to avoid lifestyle creep. Don't buy nice things. Don't let people know that you have all of this money, because the last thing that you want is all the leeches to start coming in and saying, hey, remember I bought you that burrito in 7th grade? No, don't let anybody know, fly under the radar, and keep that money so you could use it for nice things for your family and yourself. Now, step 5 is going to be investing and preserving your money. Now, there's this thing called the 80-20 rule. You're going to go with that. It's going to be 80% in the preserve bucket and 20% in the play money bucket. So in the terms here of, let's say, $1 billion, 800 million is going to go into that preserve bucket where you're going to grow that wealth, give it to your generational people, the people that you care about, the time lifelines after you. And then you're going to take $200 million and go buy that yacht, go buy the private jet, go live life, travel the entire world and see it for yourself. Because damn well you want to, and everyone should. Now, if your financial advisor isn't doing this, or you don't want a financial advisor, just put your money into a mix of investment options, right? That's where you're going to put your money into, maybe bonds, maybe T-bills, maybe index funds, real estate, any assets to diversify that wealth to make sure that if the real estate market crashes, let's say, you're going to be okay because you have money in bonds that are going to be for sure and less risky. So it makes sense to put your money in those areas. And as for your play money, you can only buy so many things, and $200 million doesn't get you much at the end of the day. So go to a startup, go do a fun venture, go do philanthropy, give back to your charity or your church that you go to every single year. Something nice. Now, step number 6 is really going to create that lifestyle design that you want. You're going to maybe want to buy a nicer house, upgrade your living situation, upgrade the cars that you drive, buy the nice things that you're going to be able to experience and as well as pass on to your family. So buying nice tickets to travel the world, buying nice homes, getting an elevator in the home because that's always nice too. Who knows? And just experience in general, because you're never going to get the time back ever again. So make sure that you go experience the world, see what's out there, because there's so many beautiful things in this life that people have yet to see. And the key is to make it last for generations. Give your family a nice trip. Give your friends and family a nice trip. Give your friends of your family a nice trip. And let them be able to make it last for generations. They're give them some money too if you really care about them, right? So, yeah. Now, winning the lottery can sound life-changing, but managing money wisely matters even more. If you can manage $1,000, then you could be ready for that $1 billion that is yet to come when you win this Powerball jackpot. With that being said, I hope you guys enjoyed today's video. And if you guys learned something new, make sure that you drop a follow and make sure that you're subscribed to the channel. Leave a like if you guys like this kind of content. Thanks for watching. Peace out. And of course, I'm no means a financial advisor, nor should you listen to this advice. And this is all for entertainment purposes only.